the financial information and the public statements, the public information that is available. It's pretty rare that people, credit analysts violently disagree that way.
Well, Lehman Brothers had a AA rating the day it went bankrupt, so they're not very reliable.
Ellen, say that again, please.
Lehman Brothers had a AA credit rating the day it went bankrupt. Meanwhile, California has a BBB rating, I think, right now, which, if you ask me, is just to hike up the rates so that the Wall Street banks get paid more in interest. I know, I'm just pulling up an article here about Harvard University. I mean, they should be sophisticated investors who are able to read these contracts, but they suckered for interest rate swaps that are, I guess they're paying $1.1 billion to get out of them. And now, I don't know if that's the same deal that you were talking about. I know that the monoline insurers lost their AAA ratings, and that's why the states lost their AAA ratings. But there's actually no reason why states should have had monoline.
Do you understand what she's saying, Terry and Betsy?
Yes.
Okay. I don't understand a part of it, and I don't know if the audience will understand a part of it, but there seems to be some discrepancy sometimes between the rating, where sometimes an organization can have a good rating, but then they can go bankrupt. So maybe it's just one of the measures, but it's not a foundational measure.
Yeah, well, my understanding is they base the ratings on past performance. So, of course, during the boom years, all these banks, et cetera, were all doing fine. And then as soon as things started to go bad, well, say AIG or whatever, an insurance company could have a AAA rating because they don't ever have to pay off these bets. But as soon as they have to pay off bets all across the country all at once because the whole market has dropped, then they go bankrupt. So the credit ratings were actually fraudulent or were not reliable.
I think credit ratings, it's very easy to pick on credit ratings as being not necessarily having a business model that makes sense when you give an example like Lehman Brothers was AA the day before they went bust. The thing about the credit rating is that it's one measure.
That's what I said, actually, is that it is one measure, but we think it's a major measure. The public thinks it's a major measure.
But in terms of the example that Lehman Brothers was AA the day before they went bust, the fact is that one measure, and a pretty good measure on the whole, but it is not meant to be speculative necessarily. It's not. We should not be asking the rating agencies, how do you think Lehman Brothers, is this a good investment or is this a bad investment in the future? Ultimately, the rating agencies, they take the data they have, the information they have. We don't necessarily want them to be too subjective in their analysis, because then we're basically asking them to help us make investment decisions. I think we have to be if we use ratings, we need to be if we use I understand that they do drive perception, but for those who use ratings for investment purposes, they need to be very clear about how those ratings are calculated and what the drawbacks of those ratings are, because they're not perfect.
Well, I think it's largely, I had read that it's largely political, that things like pension funds they can only invest in AAA rated things. So if the rating agencies lower the ratings, then all of a sudden all the funds will pull their money out of those investments. They have to. And so that will cause those investments to collapse. And therefore, for instance, Lehman Brothers, they don't mess with the rating because they don't want all the investors to be stampeding away from the bank, which is not fair.
I can't speak about anything like that. I've never seen any behavior that would indicate that that's accurate. And in fact, to be fair, I've never actually worked with any of the rating agencies on the side that rates the corporates. I've never worked with any of those guys, so I don't know. I can't speak all about any sort of political or
and I didn't mean to. I didn't mean to be putting you on the spot either.
However, you are correct in that many institutional investors have regulatory guidelines. Insurance companies, pension funds, etc., have regulatory guidelines about the minimum rating required for them to invest in certain entities. However, a AA, not the minimum for most of the large institutional investors. For most large institutional investors, it's investment grade, which means BBB and above. So Lehman Brothers could have easily been downgraded to single A, which, for example, Citibank, I think, was Citibank. That's correct, right, Betsy? Citibank was single A. They could have been downgraded to single A easily and still had a tremendous number of investors. The Lehman Brothers problem happened pretty quickly, and it was funding. It was a funding problem, and they very quickly didn't have access to short-term funding. Now, I would argue that was ultimately an incredibly risky position for them to be in, a position where this is similar to Northern Rock here in the UK, a position where they could be brought down in a day because they didn't have access to funding over a period of one day, is an overly risky position to be in. And
why did they not have access to funding?
Because the perception, apparently, among the banking community, who lend each other money every day, was that Lehman Brothers wasn't going to be able to pay anybody back. And I read some article about the fact that there were rumors, and maybe some hedge fund had started the rumor because they had bet against Lehman Brothers. I don't know.
Mm-hmm. Well, that's what I wonder. I don't think it was necessarily their fault. They were not any more on the edge.
Well, but hang on. If you put yourself as an institution in a position where in one day, if you don't have access to funding, you go bust, that's an incredibly risky position to put yourself in.
But did they put themselves in that position, or did someone else? I mean, I saw charts where there was an enormous amount of naked short selling.
They didn't necessarily create the rumors about themselves, but the fact that because rumors existed, they didn't have access to funding for one day, and they went bust. So that is a risky position for any institution to put themselves in. An institution should have sufficient funding to carry them over several days if they don't, or weeks if they don't have access to funding markets. And to my mind, I think that's one of the let's say flaws of the regulatory of the capital requirements for institutions, which is that they were not adequately capitalized on their funding requirements, as opposed to they may have been adequately capitalized for their derivatives position, for their bond positions, for all of their trading positions, but they weren't adequately capitalized for their funding position.
Mm-hmm.
That's interesting. Very interesting.
I see it from the point of view of a writer, but to my mind, they were the scapegoat, the one that had to go down so that Henry Paulson could get his bailout.
I don't know anything about that.
And you could say the same thing about Northern Rock. That could have been saved. Northern Rock could have been saved by the head of the Bank of England, by who's the Churchill of the Exchequer.
They were ultimately. They continue to operate today.
I have a question about naked short selling. Could you explain what it is? Does it have anything to do with, and does it have a place in the credit default swap market? And what should the listeners know about it?
Well, naked short selling, it's basically to go short, obviously the opposite of going long. If I go long IBM stock means I buy IBM stock. I go short IBM stock, which is the same as saying a naked short. If I go short IBM stock, it means I've sold it, but I don't actually own it to sell it. So it's like I walk down the street and I say, "Hey, Kim, buy that house?" sell it to you, but I don't actually own it.